What's up, everybody? Last week, Fed Reserve Chair Jerome Powell testified to the Senate Banking Committee, answering questions as to why he chose not to cut interest rates at this time. As we've reported, most of the industry insiders predicted that we'd have several rate cuts this year, which would provide some much-needed relief to the most unaffordable housing market we've seen in decades. With lower mortgage rates, more possible sellers could choose to put their homes on the market, giving up their super low mortgage interest rate if it isn't too much of a stretch for them. This lock-in effect has strangled our housing market, causing the lowest number of sales in 30 years. With more inventory, buyers will have more houses to choose from, therefore bringing down the competition and hopefully reducing those overinflated home prices. So why did Powell choose not to cut rates at this time? And what does it mean for our housing market? So today, we're going to take a look at an article for Fortune by Dylan Sloan titled, "Jerome Powell Says the Housing Market is in a Very Challenging Situation Right Now, and interest rate cuts alone won't solve a long-running inventory crisis," as well as Redfin's latest housing market update, which actually brings us some much-needed good news about inventory, and see what they're saying. And as usual, I will chime in with my opinion as well. So let's dive right in. The U.S. housing market is short between 3.5 and 5.5 million units, according to various estimates. Sloan reports that the roots of the shortage go back to the global financial crisis, when cautious developers were hesitant to invest in new construction, and set a precedent of undersupply that's continued until now. One of the ways that the inventory shortage could be alleviated is by cutting rates, which usually influences mortgage rates, enticing more sellers to enter the market regardless of their current low interest rate. Unfortunately, it doesn't seem that simple to Fed Chair Jerome Powell, who testified that the housing market's real problem runs much deeper, and it will take more than just a monetary policy to fix it. The housing market is in a very challenging situation right now, Powell said on Capitol Hill last Thursday. Problems associated with low-rate mortgage lock-in and high mortgage rates and all that, those will abate as the economy normalizes and as rates normalize, he said, referring to the mismatch between something approaching 90% of homeowners with a mortgage rate below 6% and our current rates above 7%. But we'll still be left with a housing market nationally where there is a housing shortage. U.S. Senator Raphael Warnock of Georgia asked Powell if he was concerned that this interplay of low demand, yet stubbornly higher home prices, and what it means for folks trying to buy a home. He also asked Powell what he thinks is driving these high home prices. Powell responded by saying, "You have a shortage of homes available for sale because many people are living in homes with a very low mortgage rate and can't afford to refinance, so they're not moving, which means the supply of regular existing homes that are for sale is historically low and a very low transaction rate," Powell said. That actually pushes up the prices of other existing homes and also of new homes because there's just not enough supply. He continues by adding that there are bigger issues for buyers and sellers than simply being locked in. There are a ton of things happening because of the pandemic and because of inflation, because of higher rates, and those in the short term are weighing on the housing market. We have this big underlying shortage of housing, and it's due to things like difficulties in zoning. It's more difficult for builders to get people, labor, and materials. But as mortgage rates come down and that all goes through the economy, we are still going to be back to a place where we don't have enough housing. During the pandemic, materials were delayed, lumber prices spiked, and there was a labor shortage, causing an uptick in costs for builders who still not have recovered enough to bring prices down. Add higher mortgage interest rates and zoning restrictions to the mix, and it's obvious why new construction hasn't made up for our lack of inventory. Powell warned that cutting interest rates too soon or too much could cause inflation to reignite, forcing him to hike rates higher than he originally planned. But by the same token, he noted that cutting rates too late or too little could slow economic growth and damage the labor market. Housing activity accounts for nearly 16% of GDP, the gross domestic product, according to the National Association of Home Builders estimates, wrote a group of housing trade organizations in a letter to Powell last fall. We urge the Fed to take these simple steps to ensure that this sector does not precipitate the hard landing the Fed has tried so hard to avoid. As far as commercial real estate is concerned, Powell added that commercial real estate is in trouble and a problem we'll be working on for years more. And there will be more bank failures. But this is not the big banks, it's more the small and medium-sized banks that have these issues. But back to our residential housing markets. The National Association of Realtors data showed that there were only 3.2 months of available housing supply as of the end of last year, about half as much as there should be in a balanced market. The good news is that the latest housing market update from Redfin shows an uptick in inventory. Redfin reports that new listings rose 13% from a year earlier nationwide for the 4 weeks ending March 3rd. The biggest increase in nearly 3 years. This boost in new listings helped bring the total number of homes for sale up 1.7%. Following 8 months of declines, February is the first month that the homes for sale increased on an annual basis. Active listings are up 1.7%, the largest increase since the 4 weeks ending June 4th of 2023. The daily average 30-year fixed mortgage rate was 6.97% on March 6, down from 7.15% a week earlier, according to Mortgage News Daily. Pending sales are still down 6.4% year over year. 39.1% of the homes did sell in the first 2 weeks, up from 37% a year ago. 24.3% of the homes sold above the list price, up from 23% a year ago. And 5.5% of the homes did have a price drop, up 1.3 points from a year ago. The median days on the market is 47 days, down 2 days from a year ago. And the months of supply is 3.7 months, up 0.3 points from a year ago. And like I said previously, a balanced market is usually about 4 to 6 months of supply. So we are still in a seller's market in most of our country. Where I am in the DC area, specifically Montgomery County, Maryland, the housing market is going crazy. Good houses are getting 12 to 15 offers, a lot of them cash, and going way above the asking price. It honestly feels like 2021, except money is so much more expensive. I can only imagine what would happen if interest rates go down. I do have to tell you, though, what I'm observing is that overpriced homes are sitting on the market, or homes that are just thrown on the market without being professionally marketed and don't show well. And they're just sitting there getting price reductions week after week. Since I work with both sellers and buyers, I have a pretty good pulse on the market, at least where I am, and I'm here to tell you this housing market is completely out of whack. There's just no rhyme or reason to it, and it feels like the pandemic frenzy. Except you have a lot of these price reductions in the midst of all these multiple offers. And honestly, it's all price points, but the most popular price point I'm noticing is the $700,000 to the $1.2 million. These homes are selling so fast and escalating way above the asking price. But it's still happening even with the higher price points. I had a listing recently around $1.5 million that still got 7 offers, all with different terms. Some with inspections, some with all cash, and a lot of them in between. One common trait that I have noticed, regardless of the price point, is that buyers want move-in ready homes. They don't necessarily have to be renovated, but they have to be move-in ready. Now, I don't know if that's just a trend going on right now, or because their money is mostly going towards the loan because of the higher interest rates, there's just not enough left over for repairs or upgrades. But as we know, real estate is very localized. So that's what's happening here in my market, but comment below and let us know what's happening where you live. And if you haven't heard of the possible silver tsunami solving our housing inventory problem, we spoke about it in last week's video, so definitely check that one out next. Thanks for watching. I do appreciate it. Bye!